Right, hello everyone. Welcome to Saturday morning. Okay, we'll get
Sunday.
ready and started. Oh, Sunday. Oh man. Oh my goodness. Okay. All right now. So we'll get ready and started in a couple of minutes from now. Jeremy, you want to prepare your slides and get ready?
Yeah.
All right, and we'll wait for more to join us. All right, really soon.
Right. Meantime, if let's say you just join us for the first time round, do go to the comments and look for the StreamYard link and click on it to enable StreamYard to view your profile, so that when you do leave comments or and ask us any questions, we know who you are and we can actually respond to you accordingly. Yeah. If not, it will actually show up only as a Facebook user without a name on our interface here.
I think Jeremy, let me just quickly show them. So I think there will be something great, so that we'll be able to have more interaction.
Yeah, sure.
Right. Okay. All right. Now, so most of you should be accessing the Facebook Live from our Facebook group itself. Okay, and in the post itself, you would see this little part over here with a link. All right, so it basically tells you that we're going live from this website called StreamYard. Okay, so before leaving a comment, please grant permission to see your name at this link itself. So if all of you could just click on the link. Okay, and then click this blue button after that. Okay, then when you start to comment on the feed on Facebook, we can actually see who's leaving the comments. Yeah, okay, all right, now, so we can actually see who's leaving the comments. So that would be great because we can address you by name and actually answer your questions by name as well. So we know that it's very targeted for your specific purpose, okay? All right, now, so just some nitty-gritty details before we get the session started and running, yeah? Now, so once again as well, if you are right now here with us, okay, we'd like to get this information that we're doing out every week right now to more and more people. So if you could just click on the share button over here, okay, just share it out with your friends. Okay, just share it out on your Facebook feed over here. Okay, and then leave a comment on the post. Okay, like stock sharing or today we're actually looking at a fallen giant. Okay, so today we're going to look at a fallen giant. So leave a comment over there and then share it out. Okay, so we can have more people joining us in the session as well. Okay. All right, awesome. I think without further ado, Jeremy, let's get the session started and rolling.
All right. Before that, good morning, Sichai, Jason, Chandrine, and Shambu. Okay. So today, I think today's session is going to be very straightforward here. It's going to be more on discussion in terms of like your understanding of stock, because the fundamental numbers is very one-sided. Again, similar to last week's numbers here. Okay, so without further ado, I'm just going to zoom straight into the company here. Before that, also do understand that the purpose of the sharing is for educational purpose, and be plenty of time whereby you'll be seeing this video, because this video will also be available for replay as well. We may or may not have positions held in the company, so we need to do this game as well. Also, before you take on any positions for this company that we have discussed, please do your own due diligence and ensure that if you do not find that they are suitable for you, you may want to seek out financial advice as well. Okay, right. So today the company we'll be looking at is actually Hertz Global Incorporation, so HTZ here. So you may or may not have heard of this company. It was actually in the limelight in the past few months here because of its bankruptcy filing. And then despite its bankruptcy, the company actually went up in terms of the stock price from like about 40 plus cents to $5 after some news that were actually announced. Right. So if you're not very sure in terms of how this company is doing, maybe you can just leave a comment. Yeah, so let's see. Okay, so Hertz itself, right, is actually an automotive vehicle rental services under its holdings brand. There are actually 4 different brands, which is Hertz, Dollar, Thrifty, and Firefly. Okay, so what it does is actually they do cars, crossover, like trucks for rental. Basically anything got to do with vehicles, rentals, you can think of them, they probably have them as well. They also do in terms of like industrial construction and material handling equipment, as well as for fleet leasing and fleet management services. So basically, right, they will operate a network of car rental locations and license their brands to associates and franchisee. If I'm not wrong, as I understand it, some of the airport transfers, whereby when you land in the airport and then they do like airport transfers from you to your hotel or from you to the location of that your intention, they will actually have for their presence there as well. Now, for Hertz, the highest segment by revenue is actually in the US car rental unit, which if you have not been living under a rock, you have realized that they will have been one of those companies that is badly hit by the COVID-19 pandemic, because generally, US in terms of their business environment has come to a likelihood standstill. Sometime in 22nd of May 2020, the company filed for bankruptcy. So for me to go into a little bit into the bankruptcy matter, I need to explain what did Hertz do. Okay, Hertz basically they finance itself by taking out loans, right, that is secured by its fleets of vehicles. So in the unlikely event, let's say for example, their vehicles fell in value, their lenders they actually have the right to request for immediate payment. So they can say, Hertz, can you make a payment now? Okay, so as long as the value, let's say the value of the vehicles drop by how much, they Hertz have to make the shortfall payment. So it was previously comfortably covered by, in a way, it's like actually covered by the vehicle's lower value now. Now, the thing is that because of COVID-19 and the fact that there was actually no revenue, the used vehicle value as well as sales value actually fell drastically. In a sense that to the point that a lot of their creditors actually requesting for their payment. And the fact that Hertz didn't have much revenue for a period of time, right, actually caused a little bit of like concern for some of them. So on 22nd of May, right, after I think it was business time, not wrong, announced an article that Hertz failed to reach an agreement with some of their creditors. Hertz actually did the filing on 22nd of May, which kickstarted a 60 days clock whereby there are creditors that actually they can't do anything with the cars that was actually used to secure the loans. So just as a backdrop, right, you have to understand that Hertz as a company, they have a lot of debts. These debts are actually secured debts. Okay, so let's go into the numbers for Morningstar. Okay, now, first of all, we look at trailing returns for the company against the sector as well as against the index here. Now, looking from the 10-year, 5-year, 3-year, and 1 year against the sector as well as against the index, right? The only word that I can use when I was thinking of the slide is embarrassing. Right? The company has not been performing either against the sector or against the index in terms of its stock prices. Now, I must emphasize this is against the stock prices. Okay? Now, as I look at the financial summary for this company, right, you can see that here, under price earnings, right, this is a dash. Right? It means that currently the company is not making money. It's not profitable now. All right? In terms of net earnings. And if you see in terms of price book, price cash flow, and price sales, for our viewers who have been following us since the start of this series, right, you'll notice that some of our viewers, they pay a lot of attention to these. They be asking, like, isn't that some other companies that we read in the past very expensive in terms of their price cash flow, price sale, or even price book? Whereas for some series, we see that price book value now is a decent value play based on the numbers now. But I would caution you to just ignore all these numbers for time being, because these numbers are at this current level because of the almost absence of revenue and sales by the company at the moment now. I would say almost, because it's a relative sense. Okay, moving forward. Now you see that this, as of the end of 2019 on the 31st of December, right, the company has actually had growth. It's actually growing in revenue as well as operating income, but it's still not profitable as of the December 2019. So you will see that, if you ask me, just looking at this, my first impression would be, okay, so the company probably has something that in 2017, 2018, 2019, they were actually able to do something to grow their revenue as well as their operating income to the point that they have not been profitable. So up to the point that COVID-19, let's say, for example, COVID-19 didn't happen, right? Then the company might have been in a recovery phase now. But because of COVID-19, the whole baseline and whole dynamics has shifted. So we just want to make sure that we don't get cheated by such in numbers here, whenever we look at Morningstar numbers. So actually dates do matter here, right? And you can see here, under the financial health portion, okay, this is on as of the 30th of June this year, the quick issue current ratio here is looking at more than 1. In fact, it's actually 1 and 2, meaning to say that the company has a means, right, to pay 2 years or more of its short-term liabilities. Now, other interest coverage portion here is a negative portion, which doesn't serve much of concern to me for the time being, because as I see, the company is actually going to be restructuring their debt. They're actually applying for a bankruptcy loan. They're looking to approach their creditors to seek out a different arrangement, which is what normally the other companies that actually file for bankruptcy will do. So this is not so much of concern. And debt over equity of 26.25. It's not too drastic for most companies that we see, but at its current level, because of how the company's numbers as a timeline, you see that this is actually a large number here. Moving forward, you see that the company, as of current numbers as of June, you see that they are actually having negative return on assets as well as equity and investor capital. So basically here, this means, lack of a better word, is that shit. Yeah. Okay. So it's like a company that is really going through very tough times and just bankruptcy and all. Like how, which makes me to see that is there any value or is there any possible play that we can actually look out for in this company here, right? And then move along here. Okay, now we look at the income statement based on Morningstar numbers here. Right, we see that in terms of net income here, this does confirm what I expected earlier. Right, since 2018, the net income has been negative, as well as 2019 is also negative. Now, the consoling part is that the net income for 2019, right, is actually not so much negative. It's actually negative 0.06 compared to negative 0.23 in terms of billion. And trading 12 months is actually a lot higher, because you see that the amount of usage for the product, or actually the car rental services, is actually going to be lower because of the shutdowns in the various countries, particularly in the various US states. You will see that there's a disparity here in terms of revenue against the net income. For example, revenue actually went up during the same period, whereas the net income actually went down. So meaning you say, right, there's something that happened in between, which will likely be expenses or in terms of their interest payment here. And operating income wise is also going up. So yeah, so I think in terms of like, it's a company whereby expense as well as that expense as well as interest payments that's going spiraling out of hand, which is something that we have mentioned in the past, whereby when we say exercise caution just to make sure that debt don't go out of hand. Yeah, this is what I mean. When you see that the revenue and operating income does go up, but the income does goes down. This is what I mean here. Okay, and normalized diluted earnings per share also went down in the same period between 2017 to 2019, as well as current trailing 12 months, which actually kind of like peaked for time being at negative 6.37. So company shareholders actually in a way are losing money here. Okay, and we see that in terms of equity, they are actually hemorrhaging, which is translating from the income statement here. Under the balance sheet here, you see that total equity fell from 1.52 in 2017 to the 2018 to 1.12. But in 2019, right, there's a certain anomaly here, because it actually went up in 1.89, but in the second quarter of this year, it actually fell down 0.67. So if you ask me, right, this seems to be a case whereby the company, right, is actually doing something drastic in this I would say maybe 3 to 4 years period, whereby they're trying to sustain the company. They're doing everything desperate to keep it afloat, whereas to a certain degree, they may be successful until COVID-19 seems to have given them another dampening shot, another kidney shot that they may or may not survive it. All right. And in terms of liabilities, you see that actually going up, and the total debt itself is actually going up. But in the current second quarter, the last reported numbers here, they're actually going down in terms of debt here. So we're seeing that they're actually doing something to restructure the company in a certain sense, but whether it's sufficiently paced to be in time or not, it actually leaves a lot to be pondered about. And yeah, in terms of cash flow numbers, we see that similarly to what we see in the previous two slides here, the operating cash flow is actually going higher, whereas the free cash flow here, which is very much a lot of focus on, that we place a lot of focus on, they're actually going down in terms of they're actually in negative numbers here. In fact, trailing 12 months wise, right, they're actually in negative 7.43, a slightly better position than in the whole year as of 2019. So where does this leave us with? like this company is getting better in terms of operating cash flow, operating income, but their net returns, their net income doesn't seem to be improving here. And if we take out 2020 statement, if I will be doing this series as of maybe say January or February before COVID-19 has actually hit us, right? I'll be saying that yes, this is a bullish outlook for the company, and we might be at a price point whereby the company, or rather a value point where the company we can actually take a small position on the company to take possible profits when the company does recover back to its more norm levels. But as of now, if we factor in the last 2 quarters result, right, it's not so good. Yeah. And we move on. You see that in terms of the price earnings, price cash flow, price book index, right, they are very much a bargain. Over here, this is where I need to caution you a bit. In terms of the fundamental analysis, right, if let's say, for example, you are not familiar with fundamental analysis, or you're just focusing on one aspect of fundamental analysis, and you don't look at the entire picture, right, this is where the value trap might happen here. Because if let's say, for example, you're looking purely at price earnings, price cash flow, price book, right, okay, this company is a sure go because it is cheaper than 5-year average, it's cheaper than the index, it's cheaper than anything else. So here, these numbers are not meaningful because this company is actually filing for bankruptcy here. Yeah, so I'm actually having these slides, right, just to point out that the possible slippery slope if you just base your fundamental analysis on just one aspect of the entire company's profile here. Now, the current return ratios is just as bad, if not worse. All right, negative numbers. Okay, now, because of the sharp fall in the equity value of the equity percentage of the shareholders, right, you see that the returns on equity will actually go down by a drastically percentage. You see -4 to -151. This is just crazy. These numbers are just crazy here. Okay, so, and if I can just use one word, right, the net margin just created. It just suddenly went into very deep sink. All right, you just imagine like a meteor landed on the surface of Earth, and then like the net margins is the hole that you see at the end there. All right, so where does this leave us? You see, under Think of Swing platform, the book value per share is actually about $12 per share for the company, whereas it's actually trading at $1.51. So where is the value that we can see in this play? Okay, so this is the option chain for HGZ. I'm going into the trade that I might be looking at for the time being. Now, under options change, right, for the standard expiry 2022, January 21st, I noticed that there seems to be this very interesting pair, budget put spread pair, for those of you who may be familiar with our project options cash flow, whereby if we would take the $1 strike price, we sell one, and then we buy the 50-cent put option, we'll be taking 42 cents credit, which with a very tight bit of a spread. What this means is that we are actually risking 80 cents. If I ignore the fees and commissions, we're risking 80 cents to make 42 cents on this position. So where's the logic? Where's the train of thought from this? Now it does stem from the point on the portion here, under here, whereby you see, if I can take you back a little bit, few months, maybe 1 or 2 months in time, HTZ, what it did is that they were trading for under $1, and then they announced that, hey, I'm going to go into the stock market. I'm going to go something like a secondary listing. I'm going to generate more equity, more funding from the stock market. And because of that news, they haven't even made sure that it happened. Because of that news, the stock prices just went up to $5. All right. So the thing is that this company, because of sheer size, right, and its book value and profile, right, it's actually a very good company to invest into in the long run. Now, the thing is that because of its current situation whereby the entire world stands still, it just fails. And I would say to a certain extent that maybe there were certain elements of mismanagement in the last decade, last 5-10 years. Yeah. But because of the quick ratio and current ratios element for these, right, there does possess some value in terms of very limited risk play, whereby, you see, companies that fail are not the companies that are not profitable. Companies that fails are the ones that fail to manage their cash flow. So, like for example, Amazon was not profitable for the longest time until they finally turned profitable, and that was when their stock prices went up and up and up. But what happened was that Amazon was able to keep up with its short-term obligations as a shifting time frame. They were able to keep up with all their short-term obligations. That's why they didn't turtle out. So my view is that because HTZ has such a strong cash equivalent in their balance sheet, they should be able to slide through at least the 1 or 2 year mark, whereby they can successfully restructure the company. And should they be able to U-turn this, then this 80 cents play for a 42 cents return would be something reasonable for me. Of course, this is not going to be something that I'm going to throw everything in my portfolio in, because there's still going to be the risk whereby they be delisted because they just fail entirely. But to me, this is something that I would consider because the slippage is low, because in terms of the offer, the slippage is low, and the risk to reward is just very reasonable to me, right? But of course, there's a flip side to this. This is the numbers for this play. So for every contract, we're looking at a deposit of $50 with a mid price of 42, meaning to say, right, you immediately have a returns of 84% upfront. You need to hold the deposit until 21st of January 2022. If you don't do anything to it, analyze the figure, that's about 59 or 60%. So if the stock prices don't fall below 52 cents, you would have broken even. All right. Now, the thing is, the caveat for this is that the debt level for the company is going to be increasing. So if it fails, this trade fails, don't think, just cut loss. All right. Just cut loss. And there's a second play which I'm considering because of the different profile here. Now, the thing is that on the standstill expiry, right, if I go to take out a big ratio, which I sell a $1 call option to collect the premiums, and I use it immediately to buy a $3.50 strike price call option at the same time, at a current bid and offer spread, I'm looking at about 9 cents credit. But because of the wide bid and offer, I'm looking maybe have to negotiate. Say, I'll be willing to negotiate up to, we say, 4 or 5 cents credit here. That means to say, right, my max loss per trade will be $250 or $250.
Jeremy, can I just cut in for a little bit?
Sure.
Can you just explain a little bit in terms of, when you mention negotiate, what do you mean when you say negotiate? Because there will be some new investors who are joining us, so they may not understand when you say the term negotiate over here.
Sure. Sorry about it. I was too excited with this. Okay.
Well,
sure. Okay. So if you can see that for the pair here, the back ratio here, the mid price that the broker is suggesting is actually a credit of 9 cents, whereas the natural price that they are suggesting you will definitely feel is a debit of 4 cents. That means in between there is a 13 cents difference here. So when you negotiate, you're actually adjusting the prices between this range, right, so that your order will feel. So what I'm suggesting is because this negotiation, this price range for you to negotiate actually falls between a credit and a debit, I will try and negotiate to the point that I'm getting at least 5 cents to 4 cents credit per contract sold. That way, even if let's say this trade goes wrong, that means the company is delisted, at least I have a 1 cent or 2 cent that I've collected. Yeah.
okay.
Yeah.
So what you're saying is because you're selling the $1 call, the bid and ask is about 90 to 98 cents right now.
Yep.
Okay, so that basically means that you are looking to sell it for around, say, you're looking to sell around 94 cents.
Around there, yes.
Okay, and then you're turning around and buying 2 of the 150 calls. Is that correct?
No,
or is it
350.
250? Okay.
350.
All right, so turning around and buying the 350 call. So what's happening is you are going to try to negotiate perhaps like 43 or 42 cents for that. Or
Yes, they're about around there.
Even harder than that, basically.
Yes.
Or somewhere
yes.
around there. So yeah, so if you look at it, if you sell something for 94 cents and then he's buying two items which cost about 42 cents each, for example, so the total cost of purchase will be about 84 cents. All right, 84 to 86 cents. Whereas he's selling something for collection of for a collection of 94 cents. So that should pay him somewhere around that 6 to 8 cents mark for the entire combo itself. Okay,
Yes.
so using that as a guideline, that's where Jeremy is saying for the ultimate combo order itself, he would negotiate for a credit to start off the trade.
Yep.
Okay, Jeremy, go ahead.
Sure. So actually, the rationale for even considering this trade is very simple. Now, for me, I do believe that, and I can see that this company is under a lot of stress and a lot of distress here. Now, but I don't believe that the company is just gonna turn up without giving a fight. Now, because of that, right, I'm just gonna try and see whether there's any possibility whereby, hey, if this company does recover, how can I take a possible profit? Okay, so I'm gonna structure any possible trades whereby I have a fix or I have a very limited loss, and but I try and maximize my return to the point that maybe it's either unlimited in theoretical sense or it's controlled that I am happy with the risk or return. So in the controlled essence, I have the budget put spread earlier, but in the unlimited theoretically, which is it will be this callback ratio here. So, but because of the wide bid and offer spread associated with the $1 call strike as well as the 350 call strikes here, so you will find that the price range for the order to fill is going to be a lot wider, and the negotiation process will take a bit longer. But for this trade, you have to exercise a lot of patience if you're going to take it. So if it does goes well, and if it does recover based on my view, then it's going to reward very well. Okay, so I'm going to move into the numbers here. Okay, so per deposit is actually 250. Based on the current mid price, is 9 cents credit, so which is returns of 3.6%. Now, under here, this trade, right, the returns is actually negotiable as long as it covers the 2 cents. For me, as long as it covers the 2 cents to 3 cents fee, I am happy with it. So as long as it pays me to wait, I'm okay with it. That's why I say I'm waiting for maybe a 4 or 5 cents credit. Now, the thing is that as long as the stock price shoots above 350, say maybe into the $6 range or more, I will be starting to enjoy profits on the entire position. Yeah. So that is where I feel that this $250 risk for the trade will be something that I may be considering to take. In fact, this trade does give a different side whereby if let's say the company does get delisted, then I will have just collected maybe say, for example, this 9 cents or nothing because the company will then be worth zero. So in the drastic case, if let's say company does get delisted, I will take the 9 cents off. That's it. But if the company does recover, I will be there's a possibility for me to enjoy a higher level of profit if it does shoot up because of the stock prices. And of course, because of these two sides kind of winning in situation, the deposit requirements is going to be higher as well. Yeah. So actually, these are my play, and at the same time, I just want to emphasize here, this company is not easy to navigate in terms of your trade. So the debt levels are going to be increasing. You're going to be seeing a lot of weird news, a lot of irrational movements for the stock prices. So at any point in time, if you're not comfortable, cut the position. Just close the entire position. And if it does go south for you, close it. Just close it. Don't think, just close it. I think your sanity is more important than the returns in the long run. Yeah. And I think that's all for me. Terence, you have any view for me? Yeah.
Yes, actually. All right, welcome everyone again. It's back over to me. So you have heard Jeremy's segment over here, and Jeremy usually covers the numbers. Okay, that means when it comes to analyzing companies, Jeremy's angle is always with the numbers and the fundamentals behind the company itself. Okay, usually for me, I look a little bit more in terms of the big picture play. Okay, the big picture play. Now, so let me help some of you a little bit. Okay, I will not delve too much into details because if you are interested over here, just head over to our website and register for the Project Options Cashflow. Okay, to learn more about what call options are, what put options are, and then if you're a buyer or seller, how does it affect your trades when the stock goes up and down? Okay, because we don't have time to cover it in full details. But what I am going to do over here is to just quickly cover some ideas that I want to put out to all of you. Okay, let me bring out a drawing board first. Okay, give me a minute.
Actually, at the same time, maybe I just take some questions that's been raised. Right. So
I was going to help you answer that question, Jeremy.
Oh, okay.
Yeah, no worries. Because I just wanted to lay out a little bit in terms of a picture format over here. What it kind of represents when you structure a trade that looks like that. Okay.
Right.
Give me a minute.
At the same time, the chat is getting a little bit too quiet today. So have I lost you all? Can you just let me know if you are getting what I'm saying? Or if I lost you all, just leave a comment as well.
Yeah. It'll be good, to always keep the session a little bit more interactive because it helps actually for Jeremy to actually know that he has thrown overboard. He has thrown overboard and lost many of you along the way. Okay, I think I'm ready. Okay, now, so all of you should be able to see a blank screen right now. Give me a minute. Edit to stream. Okay, now, so what I wanted to really show all of you is just this. For what Jeremy did, I think the budget put spread is very, very clean, so that's fine. What Jeremy is doing right now is for the back ratio, what he's doing is he's doing two strikes. We have the 350 strike, okay, and then we have the $1 strike. Now, so for the $1 strike, he happens to be the seller, okay, and then for the 350 strike, he happens to be the buyer, okay, and on top of that, there's a different ratio because he's selling one of this, okay, and then he's buying two of these, okay, all right. Now, so for such a strategy, what you are aiming to do from the strategy is you are trying to aim for what we call an explosive play, okay, now an explosive play, because the only way that this trade can be profitable is two forms. Okay, the first form is if it stays below $1. Okay, that means Jeremy is trying to do this for credit. So if it stays below $1, all the options will expire worthless, which means he gets to keep the little credit that he took up front. All right, now the second over here is if it really clearly shoots up and has a breakout above 350. All right, why? Because it's lopsided. All right, he has bought two of these call options, right? Where else he has sold one of the ones that is below. Now, so for the one call option that he sold over here, right? You can think of it this way. There is actually a pair, right? There's a 1-1 pair over here. You can think of this as 1 + 1. Okay, now, so this over here, right, happens to become a pair. Okay, now, so for this pair is essentially a $1 350 call spread. Okay, so that packs in what we call a maximum loss of 250. Okay, hence that's why Jeremy also mentioned that this trade requires a deposit. Okay, there's actually a maximum risk of loss of the 250, right? If the stock lands anywhere somewhere here, okay, to right on the dot somewhere here. Okay, so that's when the maximum loss on the one combo of the call spread happens. But if it shoots up, okay, this starts to kick in, all right? The additional profitability from the one buy call, right, which is by itself, okay, will start to lessen this 250 max loss over here. Okay, now, so typically what you want is if you have a maximum loss of 250, you want it to shoot up and above by at least another 250. Okay, because this way, right, okay, this profit over here would actually help to cover this loss. Okay, and anything above that would mean that this whole structure becomes a profit. Okay, now, so it is not too bad because Jeremy's thought and mind frame over here is that the company may recover. So if the company recovers, then we may see the stock price rise up a little bit higher. Okay, now, so for me, the only thing I kind of don't like, over here is the fact that the first, as he's mentioned here as well, the stock is a very risky play. Okay, now, so whenever it comes to a very risky play stocks, okay, where, it's like a 50-50, or actually this is like an 80-20 kind of situation, all right, 80% is probably going to end up being wrong, all right, 20% you may have that short over here. Now, so with that, I usually try to lessen up the maximum loss that I'll take on the trade. Okay, because at 250 max loss over here, that means that I can still lose up to $250 in the event that I'm wrong. Okay, this is just a personal preference. Okay, Jeremy may be able to stomach that because he's thinking more like a trader like. Okay, but if I'm trying to take a little shots over here as an investor, then I really don't want to take very expensive shots when it comes to these plays. Okay, now, so this is just to address the questions that was being raised over here. Okay, I think it was
by Will.
Yeah, all right, it was Will over here who raised the questions. Sorry. What was the maximum risk over here on it? Yeah, all right. Now, so the maximum loss will only happen. Yeah, all right. Yes, actually, if you place an order, on the order summary, it'll show you that the maximum loss is going to be somewhere around $250 for that one contract. Okay, that's how option works over here. Okay, all right, great, Shambu. All right, I'm glad it helps you understand a little bit better. All right, now, so once again, we have a Facebook user on our end. Because we can't see who's commenting. Can you click on the StreamYard in the post itself where the live session is going on? There's a link which goes to StreamYard. Can you just click on it so we will be able to see who's commenting over here and be a little bit more personalized when we answer your questions. Okay. All right. Now, for the rest of the questions, we'll hold it to the back. Okay, we'll hold it to the back over here, and then this part. I will flash this question right now because this is where I come in. All right, this is where I come in. Okay, all right now. So once again as well, Facebook user, as I said, if you don't approve, that's how we see you on our back end over here. All right, so it'd be great if you can actually approve it. Yeah. All right now. So thank you very much. So let me get to my part. Okay, and then we'll answer the rest of the story, the rest of the questions that some of you have raised. Okay, now so my part this week is to deviate. Okay, this week, Jeremy and myself have different opinions. Okay, yeah, all right, we have totally different opinions. He's on the hope side. Okay, I'm on the totally no hope side. Okay, right, I'm totally no hope side. All right, this company to me, all right, it's bankrupt. Okay, all right, that's how I look at it. This company to me is a pure bankrupt. Now, so let me state to all of you one of the reasons why I say this company is a pure bankrupt. Okay, one. Because one of the most aggressive investor, okay, one of the most aggressive, many people will call him heartless, okay, heartless, but the right term will be to call him very shrewd, okay, he's a very shrewd investor, all right, that you may know, you may not know about, right, his name is actually Carl Icahn, okay, Carl Icahn, all right, you can go just do a Google search on him, you get a lot of information on him, all right, and all the various shrewd deals that he has done so far. Okay, now, so Carl Icahn has actually recently got into the share, Jeremy, correct?
Yep.
Yeah, all right. He actually got into the share and bought a pretty substantial stake at about $8 for Hertz, right?
Maybe I just share the screen to show that.
Yeah, sure.
Okay, so this is from one of the services that we use to actually as part of our research here. So this is the part that shows the insider transaction. Essentially, you're thinking of high value transaction here, right? So sometime on March this year, Icahn under Icahn Capital LP purchased $84 million worth of stock at $8.06 a share, and then Icahn here. On the 28th of May, Icahn sold them for 72 cents a share for 39 million. So the value of the stock, okay, so back in March 13, he bought, this is 11 million share, and then he sold 55 million. thereafter on 28 million. So you would have actually accumulated the shares, more shares even before 13th of March. Yeah.
Yeah,
So
so
I
he
think
probably already had a stake in the company before going into this issue. And then,
Yes.
going into the issue itself, he just decided to liquidate his entire position. Now, let me just try to get into the mind of this investor. He's usually an investor where, once he spots investable company that is not well run by the board of directors, okay, what he'll do is he'll make a shrewd acquisition into the stake of the company, all right? But he will always buy enough percentage of the company to get a say. Okay, now to get a say in terms of what sense? He will always try to put one of his guys into the board of directorship. Okay, that's one of the criteria of how he will go into purchasing a company, because his whole idea is to take over the board. Okay, take over the board and shake it up. Okay, what he wants to do is to shake it up and then tear the company apart to keep only the profitable parts, all right, and then start to find ways to dump off the bleeding parts. Okay, and then when he's able to do that and when it's complete, right, so the company share price will recover, and once it recovers, right, that's when he exits out of the company. Okay, so that's his play. That's why he's really called heartless. Okay, he's heartless in that sense. Okay, but he's also very shrewd. Okay, you can see what he's trying to do over here. Now, so he obviously probably bought into Hertz with the idea of what Jeremy said, and with similar intentions after looking at some numbers. But there is a problem. The problem is, of course, the unexpectancy of COVID hit. All right, and this COVID actually brought the demise of the company. Okay, I'll share with you one of the reasons why. Okay, there's two actually. Okay, now, so first, because Carl Icahn is willing to take such a substantial loss, okay, that shows to me that there's no hope on the company, because one of the probably biggest hope that for Jeremy's play to work out right now is probably a white knight. Okay, that means a white knight to come in and announce that they're going to take a large stake in the company, all right, and then take over the company, okay, and then pay off liquidators. Pay off the creditors, but it's not going to happen because Carl Icahn was probably the best bet. So can you imagine, all right, you're some other great investor in the market, all right, and you're considering this company, and then you just look at what Icahn did recently. He bought it at $8, he bought a substantial stake at $8, and then he's willing to liquidate it off at just 50 cents. All right, now, can you imagine what it kind of says? It doesn't mean that it's hopeless, but I wouldn't fight it. Okay, I wouldn't want to fight it. Yeah, okay, so that's my first stance. Second, one of the reasons why I say that the company is officially bankrupt, okay, is because technically it happened way before. Okay, why did I say it happened way before? Because first, okay, the moment Uber got hit, the moment Uber started to get trending, okay, then came Lyft. All right, so what happens now is this. Can you participate a little bit as well? Okay, let me know your thoughts. Okay, now, so if you travel to America right now, okay, we all know that taking taxis in America is very expensive. Okay, now, so this will result to most of us actually considering renting cars. Okay, now, but what now with the launch of Uber? Okay, do you agree that there will be less of a demand when it comes to trying to rent cars anyway? Yeah, okay, all right, for example, okay, in Singapore, okay, considering renting a car to drive for the entire day, or versus just clicking on your Grab car right now, okay, to all the destinations that you need to cover in terms of today itself. Okay, which one will you choose? Okay, just let me know your thoughts in the comments. Leave it under your comments. Okay, because the way I see it is this is definitely one pressure when it comes to Hertz. Okay, travelers, they may actually have part of them who will be opting, all right, to go on Lyft and Uber rides as compared to renting a car. Okay, maybe not family travelers, okay, but maybe the single business travelers. Yeah, okay, may make more sense, right? To just click on a button, have my car ready the moment I'm out of the airport. Of course, that's not happening right now. Okay, all right, but you see what I mean? They lost a certain clientele. Okay, and as Uber starts to eat more and more into the market share, right? Okay, it creates more problems for them, and they are already in trouble before that happen. Yeah, okay. Now, and the next problem is also this: more competition, right? Okay, when you go to the airport, you don't just see Hertz, you don't just see Thrifty, right? You see other competitors like Avis and stuff like that, and even the local companies. Yeah, okay, Hertz is global, which means even in Singapore airport, even in Malaysia airport, you probably see Hertz. You'll probably see Thrifty. Okay, but you also see Avis, and then after that, you see some of the local companies as well. So this is what we call competition. Yeah. Okay. Now, so competition also affected their entire business model. Okay. Third, okay, it's a very capital intensive business, which means, right, they have to constantly take out loans to acquire new vehicles, right? And this cannot be helped, okay, because once the vehicles start to get over a certain age, right, they will keep only a percentage of the old vehicles, okay, for people who might want to rent cheaper vehicles, and the majority of them will be sold off to acquire new vehicles. Yeah, all right, that's the nature of the business. That's why we say it's a very capital intensive business. A lot of investment needs to go in year after year because cars will be retired and then new cars will be bought. Yeah, so you see that's another problem over here for me. Okay, now, and then the last one over here, right, is really this, COVID. So what has COVID done? COVID has done two things to stab the knife into this company. One, traveling. Okay, traveling has totally stopped, right? So which means right now, Hertz is pretty much like Royal Caribbean. Okay, where, you know, in the last earnings result, right, you literally saw Royal Caribbean announcing that revenues have fallen by 92%. Can you imagine when you are running a company and your total revenues fell by 92%? It's as good as you not having any more income at all. All right, but the problem is that employment goes, right? The car rental payment goes. Can you imagine where are they going to come out with this money? Because they already didn't have those money in their banks to begin with. Right, so that's one major problem, and they don't see the light of when things can resume. Yes, internal travel in US is starting, right, but it's still slow. Okay, it's still slow, right, and then you know, international travel is not happening yet. Okay, so it's causing a lot of problems and strains. Next, you may not think of it this far, but the biggest problem right now is also this: everybody is staying home. So what's happening right now is when everybody stays home, right, less accidents on the road happen. And when less accidents on the road happen, right, less rental demand for cars, right, due to accident repairs. Because one part of Hertz business, right, is actually car accidental repairs, right? That means those car loans over here that they make out to car yards and stuff like that. Yeah, all right, that's actually part of their business. So they also lost this part. So literally they lost every single part over here. All right, and you know what they've done in May, which caused Icon to sell, is actually filing a Chapter 11. Okay, now, so you must understand, Chapter 11 and Chapter 7 is different. That's why some of you are asking. That's why I literally flash once again Will's question over here. All right, let me find it, and I can't find it. Yes. Okay, now, so a company that files for bankruptcy, can it still come back into the market? All right, now, Jeremy, you may not know this. Okay, Jeremy, you may not know this. Okay, now, but this is the trend. That means when they file for Chapter 11, right, they're technically not going to get delisted yet. Okay, Chapter 11 is a filing where it allows the company, right, to work with creditors to find a solution. All right, how are you going to pay them? Okay, and if they're going to be satisfied. So if you can satisfy them, all right, you can restructure and then get alive again. Yeah, we have seen some company do that. Okay, but if they can't, there's two steps. One, they come to an agreement, because if they go bankrupt officially, right, everybody doesn't benefit. Okay, all right. So one, they can come to an agreement, right, where, right, the creditors know that by letting you go bankrupt, they are not in any better shape. Okay, they're not in any better shape. So what they'll do is they will renegotiate with you, okay, to take a liquidity stake in your company. Okay, that means to allow you to continue running, right? Okay, they will become equity stakeholders, right? Because the debt is going to be cancelled. Yeah, okay, but they will take up an equity instead. But in such a criteria, right, you must understand, that means the company will get reorganized and it will be relisted. That means lifted back into the market, right? But there's a problem. The problem is unsecured creditors and stockholders, shareholders are gone. Because the creditors are not going to approve, right, share distribution to these people. Because if the company is allowed to distribute shares to you who own 1,000 shares of Hertz, okay, that means their stake in the company has gotten smaller. Yeah, all right. So what it means over here is when this happens, right, okay, they will come out, okay, the creditors will come out with less debt. Okay, they'll come out with less debt over here. The company will come out with less debt Because they reach an agreement with the creditors. Okay, and what they'll do is they'll issue new equity. Okay, but in the form of issuing new equity, right, which will only be the secured creditors, right, all the old equities, right, will be cancelled. That means you, right, the shareholder right now, okay, you will find that your shares are cancelled. They are gone. It's as good as bankrupt and restarted. Okay, and the new shares will only be allocated to the creditors who have negotiated with Hertz. Yeah, so even if they relist in the market, right, it doesn't benefit you because your shares have been bankrupt, has been retired by the company. Yeah, okay, simply because they couldn't meet the demands. Yeah, okay, now, so that's one way. So even if they relist over it, it doesn't benefit you. Okay, now, second, right, if they officially go into Chapter 7, okay, that's it. Chapter 7 is gone. That's where they get delisted, right, and then you will not see the company in the stock market listing anymore once the process is completed. So hence, right, okay, it is very likely, okay, it's very likely based on the current situation and demands, okay, and what the company has in terms of asset versus the total amount of debt, okay, there is no way, okay, if you look at the numbers, right, that the creditors will be able to be paid in full. That means even if Hertz liquidate all their cars, all their assets, all their buildings that they may own, for example, yeah, okay, all their properties, okay, right now their debts are still higher than that amount. Okay, so the creditors can see that. Okay, so what's going to happen is they're not going to allow, okay, the company to restructure, and even if they do, right, they're not going to allow unsecured debt holders or equity holders to have any stake in the new agreement. Yeah, okay, all right, so they're going to reject any such proposal. So if they come to agreement on any proposal to allow Hertz to survive, right, it would mean that they are the only ones who will benefit from it because they've already lost a huge chunk of money. All right, they're not gonna play charity anymore, right? Because they are in that salvation mode. Okay, so that was probably one of the reasons why Icon sold everything, right? He saw this, okay, to me, yeah, all right, he saw this. Okay, so like I said, if he's gonna be able to see this and see these numbers, hopeless lah. So to me, it's just hopeless, right? So I was telling Jeremy this week, right? I want to get a little bit cheeky. Okay, I want to get a little bit cheeky over here. Now, what it simply means is this: we do not know when it's going to delist. Okay, we do not know when it's going to delist. So, anytime until it delists, right, the company is still going to appear in the stock market. Yeah. So what I'm going to do is like Jeremy. Okay, I'm going to take a very long-term play on it. Okay, just for the sake that I will be in there all the way until the process is completed. Okay, but the difference is this. Cheeky in the sense of whether I take this trade or not, okay, it won't affect my entire portfolio. Yes, it's going to involve investment, but the investment is so small, all right, that I'm willing to take a stake. Okay, ready? All right, now who's ready to hear my cheeky play over here? If you're ready to hear my cheeky play, just type the word cheeky, okay? I want to see how many of you are still alive in this room. You can type the word cheeky.
Anyway, Terence, I think this is gonna be one of the very good proof that we really don't rehearse these beforehand because we really have a very different view on this company here.
Yeah. All right. Remember, these sessions are not meant to be yes sessions where Jeremy and me, we have already colluded together and then come up with a story and a play for the stuff. No. All right. It's really literally taking a pick. All right. And then we say, okay, go form your opinions. All right. I'll go form mine. All right. And then when the session starts, let's really go and see what we want to do with this. Yes, that's precisely the point, Jason. You got it. Thank you very much. Yep, that's pretty much it. Yeah, it's the weekend. All right, it's the weekend. All right, now, so by running such sessions over here, we also want to have fun. All right, because if it's not fun for you guys, and it's gonna be really, really boring and dry, then it doesn't benefit you. Okay, so if it doesn't benefit you, then it doesn't make sense for us to continue running the sessions. So this is why we always say, if you do enjoy our sessions weekly over here, do help us share it out, okay? Because by reaching more people, we would actually be encouraged to put out more content, okay? As some of you have joined us, you realize, okay, we really kind of try to put out as much content as we can, and we do not hold it back. Okay, all right. Now, but of course, if you are our community member, you will understand it a lot more than someone who has not started their options journey yet. Okay, so if you want to start your options journey, just head over to our website. Okay, we have some informations, we have some different programs that you can put yourself on the wait list over here. Right, we are all ready and prepared to officially start it public in September. Right, so this is the time to really head on to our website and get yourself acquainted. Yeah. All right, now, so how about the rest? The rest don't want to know. All right, Jeremy, it doesn't seem like it's too popular over here.
I think I was counting. I think I see 2 or 3.
Yeah.
Let's get at least 5 then. At least 5 for us to show that.
No worries, Shambu. All right, this is part and parcel of what the purpose and the aims of what we're trying to do in such sessions over here. Okay, now, so while waiting for the others over here, let me just pick up a question. Again, you have not clicked on the StreamYard link, so we can't see who's commenting. But anyway, if you don't follow the front part about why 350 call over here, it is pretty much just a selection, right? Just a selection of which strike, okay, to position his benefit from. Okay, that means if the stock goes up, where does Jeremy want to start benefiting? Okay, so again, as you can see the banner scrolling at the bottom, if you want to know more about buy call options and how you profit and where you profit from, just head over to our website, okay, opt into our project options Cashflow. All right, it's a daily option strategy guide over here. Right, there's a daily option strategy learning, right, where you can go through over here and you start to understand better from there. Yeah, everyone's warming up. Okay, everyone's warming up. Okay, great. Now, so let's go. So this is my play, Jeremy.
All right.
Give me a minute.
We need a drum roll effect.
Don't need. We are not so. You must understand. We're not so pro streamers over here. No, we don't have those sound effects at the back. Okay, now, so this is my play over here. Let's see if I can fire this up a little bit bigger.
Let me fire my phone. I need to screen.
Okay, all right, now, so what I'm going to do is I'm going to do something similar to what Jeremy did. Okay, I'm going to do something with what Jeremy did. Okay, but I'm going to take a much lesser risk. Okay, and I mentioned the word cheeky because once I'm done telling you the deal, all right, some of you will have that what feeling. Yeah, okay, now, so this is what I'm going to do. Because I think that the company is going to go bust. Okay, to me, it's already bust. So because I think it's going to go bust, okay, I'm going to stretch the option expiry to the furthest over here, which is obviously you can see over here, 21st of Jan 2022. Okay, 21st of Jan 2022. Now, here's what I'm going to do. Okay, I'm going to sell the 150 put option. Okay, I'm going to sell the 150 put option. What's the idea? Okay, I want somebody to finance my bet. Okay, I want somebody to finance my bet. So the only way to get someone to pay me is to sell an option. Okay, so I'm going to sell a 150 put option. Okay, now what happens over here is this. When I sell a 150 put option, right, it obligates me, okay, to buy somebody's share at 150. So if I buy somebody's share at 150 and it goes bankrupt, right, that means my maximum loss is 150. Okay, right, my maximum loss is 150. But that's not just what I'm going to do. Okay, once I collected that premium, which I'm going to aim for about 110. Okay, 110, which is the middle, right? Okay, which is the marked middle price of it. Okay, now, so once I've done that, okay, I'm going to turn around and start buying my bet. Okay, and the bet that I'm going to buy is the $1 bet. Okay, so I'm going to end up buying two of the $1 put option. Okay, so I'm selling 150, one item of it, and I'm turning around and buying double of the $1 put option. So it's essentially the back ratio as well, but I'm doing it on the other side. Okay, I'm only going to risk 50 cents. That's my difference. That's where I say it's insignificant, right? Because if I risk 50 cents over here on the entire structure of one combo, right, it's as good as me saying all my risk is $50. If I'm wrong, I lose $50. Technically not so, okay, I'll explain in a while. Okay, but my maximum risk on this trade, if anything goes wrong, that means if it shoots up like what Jeremy expected, congratulations, Jeremy, okay, but I will lose $50. So if I do one combo, I lose $50. If I do two combos, I lose $100. Yeah, okay, so you can start to see, I can map out, okay, how much I want to put into such an opportunity. Okay, Terence, I'm going to set aside $200. Okay, then go do 4 sets of combo. Because $50 per combo means 4 sets is going to be 200. Okay, all right, now, so, but this still involves a little bit of a payment. So let me show you the trade structure. Okay, so once I structure up the trade, this is how it's going to look like. Okay, I'm going to sell one of the 150 put. Okay, and I'm going to turn around and buy 2 of the $1 puts. Okay, now, this is still going to cost me, okay, it's going to cost me about 32 cents. Okay, 32 cents. Okay, why so? Why so? Because by buying 2 of these $1 puts, right, it will cost me about 71 cents times 2. So that's $1.42. Okay, that's $1.42. Okay, and by selling the $1 put, I'm aiming to collect 110. So 142 less 110 means I've still got to pay 32 cents upfront. Okay, to get the entire combo done. Okay, so that's it. All right, I get the entire combo done over here. All right, and I'm structured. So I'm going to pay 32 cents for this. So what's my different scenario right now? That means what am I looking at? Okay, what I'm looking at is this. If the company goes bankrupt, that means they find that, okay, it's pointless. Let's stop talking over here. Just go bankrupt, all right, and they'll write off all their bad debts. Okay, now, so if that happens, right, the stock is going to get delisted, which means officially it goes to 0, right? Now, so if it goes to 0, this is what's going to happen. Okay, I'm going to lose 150, okay, on the 150 put. Okay, like I mentioned earlier. Okay, I'm going to lose 150 maximum loss from that. Okay, but at the same time, I bought 2 $1 puts. Okay, I bought 2 $1 puts. Now, so the $1 put will make me $1 in profit when the stock goes to 0. Okay, so that means when I have 2 of them, right, I will make $2. Okay, can you see over there? Yeah, okay, all right, I'll make $2. Yeah, okay. Yes, correct. Yeah. Yes, so I'll make $2 over there. Now, so what happens over here now is this. I would, let me calculate if I'm correct. Yes, the right way to portray it is this. Like I mentioned to Jeremy again, let me pull out my PowerPoint so I can draw it out. My PowerPoint disappeared. Give me a minute. Let me swap over. Okay, here we are. Okay, now, so the stock is right here right now, 150, right? Oh. Okay, pardon the technical difficulties. Okay, now, so the stock is here. Okay, so what I'm going to do right now is I'm actually going to sell this 150 puts and I'm going to buy 2 of the $1 puts. Okay, 150 puts, sell, buy. Okay, now, so when the stock goes to 0, right, what's going to happen is this. So I have 1, 1, okay, and then plus 1. Okay, all right, plus 1. Now, so you realize when the stock goes to 0, okay, I would have to absorb, okay, I will have to absorb a 50-cent loss over here. All right, this is 150 over here and $1. So I sell 150 and I buy $1. All right, so this will give me a maximum loss of 50 cents. Okay, 50 cents. Okay, all right, now, then what's going to happen over here is I bought an additional $1. Okay, so because I bought an additional $1, when it goes to 0 over here, right, I'll make $1 from here. Okay, $1 from here. Now, so $1, okay, less the 50 cents over here would mean that I'll end up with a profit of 50 cents. Okay, a profit of 50 cents over here. Yeah, from this entire combo when it goes to 0. Okay, now what's my outlay? My outlay is a margin, okay, or a deposit for the loss of 50 cents, okay, from this entire structure, okay, plus, okay, the 32 cents, okay, that I'm paying up front. Okay, so that's my investment. So right now, what's going to happen is, okay, I'm going to end up making 50 cents on an investment of 82. Yeah, all right, of 82 over here. Okay, so that will put my ROI at about, let's see, this math is a little bit more difficult. About 61%, right? 61% until and when the official bankruptcy comes out. Yeah, okay, all right. Now, so this is basically how I want to structure this trade. Okay, and I only need to put out $50. Okay, once I paid the 32 cents. Okay, I only need to put out $50 over here to get it structured and done. Yeah. Okay. Now, so this is the back ratio. Is there a simpler play? So some of you will be asking, Terence, is there a much simpler play? This is a little bit complicated for me. Yes, there is. Okay, you can just go out there. Okay, go out there. All right, and pay the 70 or 71 cents. Okay, go out there and buy the $1 puts. Okay, go out there and buy the $1 put. Don't risk too much. Some of you will be asking, Terence, why don't you buy the 150? Don't need too much. All right, if you believe it's going to go bankrupt, just buy the $1. All right, it will cost you about 71 cents. Oops, clicking in the wrong place. All right, it'll cost you about 71 cents over here. All right, and when it goes to bankruptcy over here, you will win 32 cents. Yeah, all right, win 32 cents. Yeah, okay, now, so you'll end up making a profit of 32 cents on an investment of 70 cents over here. Yeah, so that's about 50% return as well. Yeah, so if you believe in that the company is totally busted, all right, this is a very, very cheap kind of play over here that you can take up. Yeah. All right, now let's go to some of the questions over here that we have. So if any of you have questions, start throwing them out in the comments. We'll start to address them. Yeah. First one that I see. Will the stock actually go to zero though? Yes. So when it gets taken off, that's essentially zero. So once the stock is delisted, right, they will start to settle all the options as well. Yeah. Okay. So once they settle, they will just basically credit the profits and losses into your accounts with the option trades that you have. Yeah. Next one. Will, if it goes up, is a losing trade? Yes. Yep. This one is structured a little bit different because for this structure, I actually have to pay a certain amount as well. Yeah. All right. So if it does go up, I will lose the 32 cents that I paid. Yeah. Okay. So that's my loss as well. So if it goes all the way down to bankruptcy, I will profit. There's no losses there. Okay, but if it shoots up, my maximum loss is 32 cents. Okay, or $32 for one combo. Yeah? Yes, Jeffrey. Yes, for the back ratio, yes, that's pretty much it as well. All right, 50 cent profit for 32 cents paid to establish the trade. Yeah, okay, so you would see that the profitability on a direct buy put will actually be better. Okay, it's a little bit costlier to start. Okay, that means I have to pay 70 cents to start over here. All right, but I'm able to achieve a higher ROI. But some of you don't want to tie up too much capital, right? Then this is the other way. Okay, this is the other way of it. Okay, can structure on. Will, this is an interesting question. That means, can we structure an unlimited profit with minimum risk, right? Yes, I just did with the back ratio. But it was done on the downside. So you must understand one thing. On the downside, right, the unlimited profit is only until zero. Have you seen a stock go negative? All right, Will, just no offense, man, okay? All right, but I just wanted you to see the line. Okay, because if you're structuring on the downside over here, that means my maximum profit is when the company goes bust. All right, there's no other way. All right, we don't get negative numbers over here. Where else for Jeremy's trade on the call side, then yes, right? He has unlimited upside. If the stock goes to $30, $40, then he's gonna hit boomtown. All right, he's gonna hit boomtown on the trade. Yeah.
Actually, for Will's question, right? Because he didn't really state his view in terms of whether he's bullish or he's bearish, right? There's this very, very weird thought when I was writing out my analysis. I was like, the stock price is at 150, right? if I were just put it, maybe it's about under $2 around there for Sing dollars. Yeah. So if you have the habit of buying lottery, I think you buy the stock is also worth the bet than your photo.
But he just came back, right? He mentioned over here he's looking at the upside. So if you're looking at the upside, then you'll probably be looking at Jeremy's play.
Yeah.
Okay, but as you realize, to get a credit to start, the minimum on the spread has to be 250. So you are still taking at least a 250 risk.
Yep.
Okay, on the flip side, if you do think that there's really hope, I think from Jeremy's play, you could actually spin off and just pay about 40 cents to buy the 350 call. All right, 40 cents to buy the 350 call. Because if it does boom up, like the last time it surged to $5, right? Okay, if it does go back to $5 again, by paying 40 over cents, when the stock goes up to 550, for example, your options will be worth at least $2. Yeah, so that will be like a $500 profit over there. Yeah. Simply because of the cost of the option. Okay, Jeremy, I'll just take that question. Simply because of the cost of the option. Jeremy is selling the $1 call. $1 call. Sorry, you're selling a $1 call, right, Jeremy?
Yes.
Yeah. For the 94 cents. So if he's gonna buy the 250, like you are mentioning over here, the 250 is gonna cost him at least 55 cents. So 2 of that is gonna cost him 110. So he's gonna have to pay to start, just like my put side. Okay, just like my put side. So it doesn't make sense then. Okay, you still have to take on the 150 max loss, but on top of that, you have to pay the initial to start the trade as well. Yeah. Okay, all right, now, Ryan, yes, don't worry, we have differing views sometimes. Jeremy does trades that I don't approve of sometimes. That's his money. That's his money. So as long as he's prepared over here, then, by all means. And likewise, I do have trades sometimes where, on certain stocks where he's not comfortable on fundamentally as well. So that's, his prerogative, right? Everybody has different risk appetite. So that's where, in sessions like that, we try to cover stocks in different industries, okay, to get a maximum view of it. Yeah? Right. Let's see. What do we have? Ryan, if you expect it to go up, then yes, but you must understand by selling a 150 put, you are taking a risk of 150 on the downside as well. Yeah, okay, you're taking a risk of 150 on the downside as well.
Actually, Ryan, if you are doing this play, right, then I'd rather you sell the 150 put and buy the stock outright. Because the stock price is at 151 now, and if you're buying a 150 call with expiry on 20, right?
No, Jeremy, you know why? Because the 150 call cost him less than buying the stock. And he has
okay, I get it.
Yeah, so he's actually trying to aim for the credit. Okay, by buying the stock, he still have to pay for the trade. Yeah, all right. So yes, Ryan, if you are very positive, like you're on Jeremy's camp this week, then yes, there's a feasible trade as well. But the maximum loss you will be looking at is 120. So if the company goes bust, you will lose the 150 less the 30 cents that you're collecting upfront. So yes, actually, that's not too bad. All right, well done, Ryan. All right, well done. That's a feasible trade as well because the stock is that cheap. Yeah, just simply because the stock is that cheap. Yeah, okay, all right now. So yes, that's a feasible play. Well done. Okay, now just this question. All right, will the stock actually go to zero, and then likely will it be taken off when it does that? Yes, it does. So they will delist the stock. So once a company officially files for Chapter 7, right, they will have to go to courts and then file the documents. And once everything is completed, the stock will be delisted. So when a stock is delisted, it's as good as basically zero, right? So the exchange will start to, square off all the option contracts that are in the market. Yeah. Okay, so not to worry about that. So we will, like for example, the trades that I did, okay, I will actually be able to take the maximum profits maybe even before January 2022. Yeah, okay, because if they delist it in the next 10 months, by 10 months, I'll actually be able to read my profits on this trade itself. Yeah, okay, so that's one part of it. All right, welcome, Ryan, no problem. All right, actually, the risk reward is better on the upside, but fundamentals are skewed. Yes, it is. It is. All right, now, so this is why we really wanted to bring out this stock this week, right? Because when I suggested the stock to Jeremy was like, "Why do you want to do a $1 stock?" Because I think it just presented the idea that you have raised up over here. Thank you very much for seeing that. Yeah, all right. It's not just covering good stocks all the time. We want to cover a little bit of topic-driven stocks because I think it's a very good talking point as well. Yeah. All right. Now, so any more questions? Last go over here. Just last couple of minutes.
Actually, I think at this point,
yep. If you do enjoy the session, remember to click the likes over here. All right. So we know that this is a topic that you liked for today. Because
so also if you do enjoy the session, also do let us have your comments here in the comments chat box. If you don't enjoy it, also let us know why as well. We will also be able to adjust the session here. I think at this point in time, I just want to raise up what I really feel about this company that we really reviewed today. As I was actually researching this late last night, I was thinking, hey, this is really a company that there's so much different plays I can play. In fact, I think for those of you who are in our community, you will realize this, that there's so many different things you can try. You can try put spread, you can try call spread, you can try back ratios, you can try I think even what Ryan suggested earlier, or even doing long stock here. But all of these would not have been possible if we didn't start our journey to study, understand the different options. Beginning, maybe we put spreads, and then gradually over time, as we did the different strategies that Terence shows us, as well as we pick up over time by our own reading here. So I think the essential thing here is the skill set that we pick up over time. So for those of you here who may or may not be first time with us in this session, you can consider to go and click to our website, the www.impulsiveinvestors.com, to actually kickstart your project options cash flow journey to have a few of it and no cost there. And if you really find that you like to pick up a little bit more in terms of like understanding options as an instrument vehicle, you can consider be it with us or be with other trainers as well. Yeah. So I think the part is that options to me is an adult's Lego, whereby you can make money, you can lose money. If you do it right, you can make money. Yeah. So I think this is all this view here, and I'm glad I made the journey like 4 years back. Right, Terence, what's your view?
I like the way you do it. All right, now, so you do understand, right? We are just trying to highlight the benefits of options trading as a whole. We are predominantly option sellers, but in these segments over here, we will also shed a little bit of light on what options can do on the buying side sometimes as well. So, like Jeremy mentioned, right, it's a pretty reference that you're drawing, right? The adult's Lego. Yes, it is, right? Because for stocks trading, it's pretty much yes or no. Right, this stock, do I want to long it? Do I want to short it? Is my answer correct or is it wrong? All right, whereas when it comes to options, you can structure the entire trade in many, many different ways to achieve profitabilities of what you want and also minimize the risk at the same time as well. Yeah, okay, just make sure you choose the right community to go with, all right, because you have Legos, you have also building blocks, and then you have, mini blocks and the different spin-offs.
Django.
Yeah, all right. So just find the right one that tickles your fancy and just go with it. All right. So once you have made the choice over here, just go with it. Because remember one thing, once you've committed to something, all right, results will only come at the end when you allow time to verify your judgment over here. Right. So a lot of our community members who have been with us for a really, really long time, right, they have benefited and they are still benefiting from what we continue to build and offer for them. Now, so let's try to answer some of the remaining questions before we close the session, okay? Now, will the profits be capped? Once again, I can answer that question, but I think it would help you more in the long term to actually go through the daily videos that we cover in Project Options Cashflow. It is free. It is free. So go ahead, register, get the videos for free, okay? And then understand, Okay, understand what the components are over here. Because all essentially Ryan was suggesting was to sell a naked put and then buying a call option. So once you go through the videos on each of these strategy, right, you'll start to be able to understand when you combine them together, right, when do I lose money, when do I make money, all right, and then is there a cap to making money in such a strategy? Yeah, okay, I think that will help you more in terms of a long run. Okay, or actually, consider joining our community if you want to build this on a much faster track over here. All right, now, so Sarah, is it worth the wait for the option that expires all the way in January? That's why I said, Sarah, I have to structure a cheeky play. It cost me $50. that $50 is probably going to sit around in my account as spare liquidity or something like that. So you don't have to go too heavy. Just 2 contracts will cost you what, $100? Yeah. So that's why I say it's like a cheeky play over here. It's totally like almost insignificant whether I did it or not, but it's like a cheap shot at trying to prove my judgment right. Whether my feeling of what cow icon direction was really correct or wrong. Yeah.
I think if I were to add to that, right, another thing I pick up is that since I started investing, right, I stopped looking at numbers in absolute sense. I look at them in percentage sense. So when I was getting started, my account was definitely smaller, and I was thinking like, hey, the per trade size in terms of the returns is very small. But over time, I actually realized that my returns in terms of percentage-wise is actually quite respectable. So if you just put it in perspective, it's not percentage-wise, if in terms of whichever type of trades you're looking at, that might help you in the long run. Yeah, I hope that helps you, Sarah.
Actually, Jeremy, you raised a very, very important point because right now, because of how high flying stocks have gone for many stock investors, that means you could have literally bought Tesla stocks and still made 200% in just 1 month alone. Yeah, all right. But many people have forgotten the merits of what great investors like Benjamin Graham and Buffett actually says. Now, I'm not going to quote them in the sense of value investing, but I just want to quote them in terms of the long-term success that they look at. Because in our community, what we always target is about a 20 to 30% compounded returns. Okay, and many of you may not actually realize that if you compound your profits your capital at just 30% per annum, you're actually doubling your money in 2.5 years. Yeah, right now. So imagine, if you can double your money every 2.5 years and you continue to snowball all the profits that comes along with it, right? You can actually see that it's actually very, very sustainable. Yeah, because buying Tesla and making 100% profits in like 2 months, right? That's probably going to happen once every 5 years. It's like you hitting a jackpot and buying DBS shares at $7. Yeah, all right. When are you going to be able to buy it again at $7? Yeah, that's pretty much it, right? Although some of you will argue, yes, Tesla is just giving me another chance because it just split, right? So from like 2,000 plus, they went back to like 500 or something like that. Yeah, okay. So Terence, I can buy it and then it can go back to 2,000. Yes, provided if Elon Musk continues to be Elon Musk. Yeah, all right. That means he continues to inspire and perspire. Yeah, all right. And, continue to deliver. Yeah, I'm not saying that he can't. Okay, but with the current PE ratios pricing the company, all right, he has brought it to a level that it's totally unseen. Yeah, all right. Yes, it can go up higher, but a period of realization may also kick into the markets. All right, so that realization can always be hard and painful. Yeah. All right. Awesome.
Terence,
yes.
Before that, yes. If you didn't mention Tesla, I wouldn't have actually got this view. I just had this thought when I actually came back from reservist just last week. Yeah, so during my camp, I was talking with one of my friends, and he was joking with me about the investment journey of another friend that we knew. So here was what happened. It was something like this. So when Tesla was trading around $100, right, he was saying, no lah, the company can't really make money, right? Don't buy money. So then when Tesla was trading at $1,000, it's too expensive. I can't buy it. And then when Tesla was trading at where it is now, he's saying like, alamak, how I missed a big great opportunity. So my point is, a lot of people is focusing on Tesla now because it's really, really the season of the year, season of the month, and season of the season here. But when the next season comes, the next company, let's call it company X comes, if you have not done anything different between Tesla and company X during this period of time, are you going to be in the same shape whereby you're not even in a position to consider Tesla? Or have you started accumulating a little bit of cash flow here from a secondary stream or tertiary stream, whereby our people, the participants in our community have already been accumulating, and they have the choice to decide whether they like to purchase the next Tesla or they don't want to. Yeah, so I think that's the key note I hope everybody takes away here. Yeah.
Yeah, no problem. I think just one point that you also brought up to me is that, yes, you can continue to choose to invest in Tesla. They may continue to go crazy, but you do have to look at it that we have this problem. You're buying into a stock with a PE ratio right now of 5,346. 5,346. So how many years is it going to take you before you can make back your money? Yeah, all right. So it's essentially me trying to say right now, for example, let's say Singapore in a property context. All right, if you buy a District 10 condo right now, okay, and you're buying it at a 10 times multiple, which means what makes a property a good investment is usually if it can pay itself off in 10 years. But now you're buying a property at a price that is only capable of paying itself off in 100 years, right? How in any shape or form, with whatever potential that you can see in lack of supply in District 10, advancement in buildings of District 10, there's not going to be such listing anymore, whatever special project there is over here, right? 5,000 multiples. Right? Even if I want to consider buying this, I will wait for that, exodus. I will wait for the exodus before I consider going in. Right? If you are already in, by all means, stay. Find a hedge, stay. Yeah, okay, because you have enjoyed the run. You are playing with profits right now. But if you are not, okay, please move on. I'm sure traders have also told you missed it, move on. You missed it, move on. It has moved. Right? This rocket has fly without you. All right, stop looking at the rocket, because by continuously looking at this rocket, you may miss out other opportunities. All right? Yes, so what if people are posting profits on Tesla every day? You missed it. Right? They are showing you what they did, but you missed it. So look for the next one. Yeah, okay, no point harping over it. Yeah, okay. Now, so I think we have overshot over here, but thank you very much for joining us in today's session once again. We hope to see all of you in next week's session. And Jeremy, thanks for your time. I'll see you in the next season. All right, next episode.
Thanks everybody for your time as well.
Bye-bye. See you, everyone. Oh, yes, join me for tomorrow night session. All right, I will still be doing the Cashflow portfolio building live with Terence over here at 9:30 p.m. tomorrow evening. Okay, so if you want to find out what new trades I'm going to put into my portfolio tomorrow night, join me in the session, and I'll see you live at 9:30 p.m. tomorrow evening. All right, bye-bye, everyone.
Bye.